Your mortgage costs 6.37% right now. The stock market historically returns 10.4% annually. But here's the problem. Those aren't the numbers that matter for your decision. Today, we're breaking down the exact math to tell you whether you should pay off your mortgage or keep investing in 2026. And the answer might surprise you. Let's start with what we actually know right now. According to Freddie Mac's primary mortgage market survey, the average 30-year fixed mortgage rate sits at 6.37% as of May 7, 2026. That's down from 6.76% a year earlier, which created a moment where a lot of homeowners started reconsidering their strategy. On the investment side, things look pretty strong. The S&P 500 rose 17.9% in 2025, according to Fidelity's analysis, marking the third consecutive year of double-digit gains. But here's what matters for your 2026 decision. Analysts are projecting an average S&P 500 return of 12% this year, with earnings per share growth expected between 12% and 16%. So you've got a 6.37% known cost on one side and a forecasted 12% return on the other. The question is whether that forecast is real. The math seems obvious at first. If your mortgage rate is lower than your investment returns, you invest. If it's higher, you pay off the mortgage. But here's where it gets tricky. The S&P 500 averaged 10.4% annual returns over the 30-year period from January 1996 through December 2025, according to Fidelity. That's your historical benchmark. Your current mortgage rate of 6.37% creates only a 3.63 percentage point spread between what you're paying and what the long-term average suggests you could earn. That's not a huge margin. And the challenge is that analysts right now are forecasting 2026 returns of 12%, which would be well above your mortgage rate. But Goldman Sachs is more conservative. They're forecasting a 6% return to a year-end 2026 target of $7,600. If that scenario plays out, your mortgage rate actually wins. So your decision really depends on which forecast you believe. Here's the personal factor that pure math misses. If you're within 10 to 15 years of retirement and you've already maximized your retirement accounts, paying off a 6% mortgage actually starts to make a lot of sense mathematically. You've already locked in tax-advantaged growth. Getting that mortgage off your books before retirement reduces your monthly expenses and your financial stress. But if you still have time to recover from market downturns and you haven't maxed out your retirement contributions, continued investing typically wins over a long horizon. The key difference is that money in a 401k or IRA stays locked away until retirement age. So does mortgage principal. Once it's paid down, you can't access it without refinancing. Where you are in your life and career matters as much as the numbers do. Beyond the spreadsheet, there are three real factors that matter. First, your mortgage rate relative to expected returns. Second, your retirement timeline. Third, whether you've maximized tax-advantaged retirement accounts. But there's a fourth factor that advisors often mention: psychology. Paying off a mortgage gives you something the market doesn't: a guaranteed win, monthly cash flow relief, and lower housing stress. Some people sleep better at night with less debt, and that benefit is real. Your job stability matters too. If you're in a stable, well-compensated career, you can handle mortgage payments and investment volatility simultaneously. If your income is variable or you're facing any job uncertainty, having lower monthly expenses becomes more valuable. So the answer really is, it depends on you, not just the math. Most people don't face a choice between 100% mortgage payoff or 100% investing. You can do both. The sequence matters, though. First, contribute enough to your 401k to capture any employer match. That's free money. Second, max out your tax-advantaged retirement accounts. For 2026, that's $23,500 for your 401k and $7,000 for your IRA, with catch-up contributions if you're 50 or older. Third, build an emergency fund of 3 to 6 months of living expenses in a high-yield savings account, earning around 4.5% APY. Only after you've completed all 3 of those steps should you allocate surplus funds between mortgage payoff and taxable investing. Once you get there, use your mortgage rate and your timeline to decide. It's not either or, it's both, in the right order. The full analysis, including specific scenarios from Goldman Sachs and Morgan Stanley, is available at the link in the description. If you found this helpful, subscribe for more grounded personal finance content that actually uses real numbers and real sources. All the studies and forecasts we cited are linked below.